Hi, Jennifer Warren here, and I'm actually going to talk about oil markets today. I was asked by Seeking Alpha, the crowdsourced investor platform, to weigh in about what I was thinking about US oil in relation to the global oil market, because there's been obviously massive amounts of focus about developments in the Middle East between Iran and Israel. And so they wanted me to kind of weigh in and talk about what I thought in general. And basically, I want to sort of talk about the fundamentals of oil markets. And I'm also going to talk a little bit about gas and also just a touch on semiconductors. And I'm going to slide share. So first, I want to look at the last 5 days. And as we can see, WTI has been up. Well, this is 10%. As of last Friday, futures were up 7% and then 12% the 5 days across the 5 days before that. Today, there's been like a 2 to almost 3% price rise, and it's at like 73.8 right now, something like that. And here I wanted to add in natural gas because I just want to show sort of some of the volatility of oil in relation to natural gas as well, because many producers produce both. And so this is kind of interesting to look at. And I also wanted to look at XLE, which represents a lot of the oil and gas industry in sort of like a macro way. And obviously there's a little more stability, but the track is a little bit up too. And that's with elevated pricing, as one would expect. And I've thrown in SMH, which is kind of my proxy for semiconductors, because I want to look at that in a larger context, just for some of the work that I'm doing. So this is just showing crude oil prices, kind of some of the potential variation ahead. And so crude oil a la WTI pricing is really reflecting the general macro. As we can see here in 25, there was just this steady drone. And then, we do see some volatility because of the tariff. But one thing that's kind of interesting to think about is that maybe with lower oil prices relative to where they were, like in those 70 ranges, some months back, it may help keep oil demand sort of cruising along at a steady state. And here I just want to look at year to date, just because I want to have a little bit of a longer view. So as you can see, WTI has been a little bit more steady, year to date, rising 2%, natural gas 5%, and XLE 3.5%. Now, semiconductors, and NVIDIA is one of the largest constituents of this SMH ETF, almost 9%. And, we know that all that's very much on a growth tear, but there's a lot of relation I'm starting to see between energy and chips and things like that, and I think that's going to be interesting to watch going forward. But as you can see, there was this sort of more steady state, if you will. So this is just within the month, and because I wanted to show sort of the before the tariff effect, and then sort of after, where things are starting to come up. And because that was really in April that things went really kind of south, and I'm kind of trying to show how it started pulling up. Natural gas up 14% in the last month, crude 16, 17, XLE 5, semiconductors almost 7. And then here I just have the ETF AMSA reflecting midstream. They've kind of been caught in the middle of a lot of this because of the idea that, if there was in fact a potential recession, then it was going to lower the volumes in general. And so that was kind of, I think, what that is reflecting. So they got hit a bit with that. So now this is kind of just getting to some fundamentals, because, there's a lot of talk, there's a lot of focus on futures pricing, but this is sort of what is happening. And what is happening is, in fact, that U.S. petroleum crude oil exports rose almost zero point 0.6 million barrels a day just last week. So that's interesting because it kind of shows you this fungibility of oil markets. And with this perceived and actual risk in the Middle East, the United States was really picking up a little bit of potential slack. So that's kind of interesting. So we've talked about a call on OPEC before when we were talking about peaking oil, a few months back, peaking U.S. production. Now we're talking about the call on the United States. Um, and then this is just showing, I just want to kind of show where some of the U.S. production is coming from. Texas is like 43% roughly of U.S. oil production in 2025. And as you can see, we're upwards, 13 million barrels a day, something like that in the United States, period, with Texas being, the lion's share of the producer. And a lot of that has to do with, supply fundamentals and sort of cost, being a lower cost producer a la the Permian, and also with all the infrastructure networks. So that also weighs into the Texas play. And that also is just about scale. So just the idea that, in oil production and gas production, scale matters. But I also just want to mention it is part of a whole story going forward, oil, gas, power economy. So this is just showing some petrol demand, crude oil, and so we're heading into the summer driving season. And what this reflects, if you look at this, for the last year, there's just been this kind of, relatively steady state of demand, if you will. And also, in fact, petroleum demand rose a little bit versus the week before. So we're not necessarily driving any less. And I think with a lot of the policy that's in play now, I think we're going to just see a little bit of more of the same. Um, and also, I just want to mention that demand is sticky. There's an inelasticity factor in demand and an inelasticity on supply as well. And the U.S. now, as this major producer on the global stage, we weigh into that equation on pricing. I also want to mention that the United States is driving like about 274 billion miles a year, and that has been in a relative band since 2021 even. So we're not driving any less. And then finally, I just want to show this. I thought this was interesting. If you look here at 2011, this is really when the crude oil shale takeoff started happening. Before here in this phase, this is the shale gas takeoff. And gas was, kind of wagging the dog's tail, if you will. And then oil starts kind of becoming more important as the price of oil goes up. And then if you start looking, of course, here's the pandemic, everything, demand destruction. And then things have kind of moved in lockstep. And now you've got this really, really tightness going on. And I think that's kind of interesting. And also just to note that we're a good solid 110, 115 BCF per day market in the United States of natural gas. And that is set to rise in the future. I'm going to stop sharing. So just pivoting off of that last chart about the idea of lockstep. Now there's a lot of reasons for that to, disentangle a little bit. But what I can say is, in the last, 5 years, shale has been on the increase, both shale oil and gas. And with the OPEC play, everyone's saying there's going to be this call on OPEC in the, late 2029, 30 era and beyond. While that may be true, the United States really does impact pricing more so than in the past. We started being added into the Brent benchmark some years back, and I noticed that, and I've written about it in the past. And so now we with WTI at like 73.8 right now. I just looked it up. And then Brent is trading the futures price at 77.5. As you can see, it's a really tight band. It's like a buck and a half basically. And so if we did not have the United States WTI in the Brent constituency, you would see Brent be higher with all this volatility. So you're welcome, rest of the world, global oil prices. But anyway, so that's kind of the other place where the United States is important in global oil markets. We're a trader. We're an important trader in the global market. As you can see from the slides I just showed, that in fact, we were picking up some market share or increase, owing possibly to this volatility, although I can't identify it exactly. So what it says to me too is, in the past, OPEC will make announcements and the market will react and go one way or the other based on that. And I think what this volatility of the Iran-Israel conflict in the Middle East is sort of reflecting is that you can't really jack around with oil prices as much as you think you can, and for all the reasons I just talked about, to do with sticky demand, U.S. production. It's a market. And also you have like the UAE and Saudi Arabia wanting to, play in other spaces. Saudi Arabia with, the AI push, economic diversification. The UAE is same, but also the UAE and one of their oil firms, ADNOC, I believe, has been, sort of starting to buy up United States natural gas assets. So I think that's kind of indicative. So there is a market reality that drives everything in spite of shocks and everything. And I think there's a real will, to have less threat happening ahead. And I think that there is the potential for there to be further stabilization once we get past some of this intense geopolitical conflict right now, and it's in everybody's interest to do so. Thank you.